In today's video, we're going to be talking about a recent change that StashAway has made to their portfolios. They've made some really big changes. You're going to want to stay till the end. My name is Emir and welcome to the Millennial Finance. It's here. StashAway has finally re-optimized their portfolios. Adjusting our stock portfolios based on market trends and conditions is what we pay StashAway for. Their fees range from 0.3 to 0.8% per year, and the reason they charge this is because they're supposed to identify changes in market trends and adjust our portfolios accordingly to maximize our returns. I expected a quicker reaction from StashAway for the 36% decline in March 2020. To be fair to them, the decline that we saw due to the pandemic is one of the fastest and steepest declines we've ever seen since I don't even know when. So, I'm going to look past that and focus on what has changed. For some reason, I'm super excited whenever they make changes to their portfolios because I just like looking at what they think of the market versus what I think of the market. Obviously though, they should be doing more research and be better informed than I am. At least that's what I hope. Let me start off with the justification of why they've made these changes. Do note that this only impacts those of you who have opted in for the auto re-optimization, such as ourselves. Let's get started with point number one, being they adjusted for valuation gaps. Basically, StashAway is saying that they identified that some of the funds in our portfolios are too overvalued. What they did was they shifted some of these funds in the overvalued stocks into ones that have smaller valuation gaps. That's a good decision to make, but we need to really understand what stocks did they think were overvalued. Secondly, StashAway decreased their exposure to the US dollar. The Fed, which is the central bank equivalent of the US, has decided to print tons of money. They did this to help support the economy, which was failing due to nationwide lockdowns. As a result of this oversupply of the US dollar, the valuation of the currency is subject to risk. When the value of the US dollar decreases, our value in Malaysian ringgit, when we convert it back, also decreases. When the supply of money goes too high, the prices go down. The third thing that they did is they introduced some new ETFs into their asset classes, specifically the Chinese and emerging markets one. They reintroduced two new ETFs, being the Chinese Technology ETF and the Emerging Markets ETF, while at the same time reintroducing the All Asia Except Japan ETF. The reason they made these changes are because they feel that China has a lot of room for growth and their stocks are very undervalued in comparison to American stocks. The last thing that they changed is the increase or maintain the exposure to gold. As a safe haven asset and a protection against a devaluing currency, they feel that it's time to jack up their allocations. Many institutions are doing the same thing in response to the Fed bazooka. So those were the justifications that StashAway give for changing our portfolios. But let's take a look at how different our portfolios really are. In this case, I'm going to be talking about my portfolio, which is the highest risk one, being 36%. If you're not on the same portfolio as me, don't worry, as the changes that StashAway have made are pretty much the same across all risk levels. Their allocation for international equities has increased at the expense of the US ones. We'll go a bit more into this later. What they've introduced now are REITs, which basically are investments in real estate properties. Investment in REITs usually generate high dividends and low volatility. In recent times, companies like Google and Facebook have decided that their employees will work from home for the rest of the year. CEO of Twitter, Jack Dorsey, took this one step further. He told his employees that they can work from home forever. If the HR of my company is watching this, I hope you take notes, and I don't mind working from home. Anyway, back to the point. These developments don't bode very well for REITs, especially those in the office leasing area. As more and more companies start to realize that we don't really need an office to work, they'd happily take the cost savings associated with remote working. When less companies want an office to work in, the demand for it goes down and the price of REITs also go down. In terms of dividends, a lower profit for these REITs generally means that they'll pay us out less as well. This is of course merely my opinion and things could pan out very differently. Maybe a vacant office space will be quickly picked up by another company. Who knows? After all, REITs only account for between 6 to 8% of this entire portfolio, so I'm not too fussed about it. It's a nice diversification to have and it's something that I don't have anywhere else. Another thing that they added to my portfolio is the investments in gold. It seems to me like StashAway is going full on risk averse mode because even on the highest risk portfolio, such as on mine, I have an allocation of around 20% in gold. For those of you who don't know, gold is generally regarded as a safe haven asset or an inflation hedge. It's not meant to generate the high returns that signifies a high risk portfolio. However, it's difficult to argue with this when gold has a 1-year return of 35%. This completely trumps the S&P 500. I guess this is also in line with their fears of the devaluing US dollars. When the currency goes down, a lot of people tend to shift their money to commodities like gold as a safe haven protection. Personally, I would have preferred a smaller allocation to gold than this. 20% seems a bit excessive for the highest risk portfolio an individual can take. StashAway, if you want more risk in this, let's try Bitcoin. Alright, so now let's take a look into what they changed in the international equities portion. As I mentioned before, they've introduced 2 new ETFs, being the Chinese Internet and the emerging markets. At the same time, they reintroduced the All Asia Except Japan ETF. Notable stocks that belong in these ETFs include Alibaba, Baidu, JD, and Tencent. To accommodate for these new ETFs, StashAway decided to completely remove their investments in the European and the US stock markets. This is what I call a bold move. On the US portion specifically, the S&P 500 is generally regarded as the cornerstone of most investment portfolios. Over the last 5 years, the S&P 500 would have generated an annualized return of 9%. In comparison, the 3 new ETFs have returned 5%, 0.8%, and 0.5% respectively. All 3 of them have lagged behind the S&P 500. Of course though, we need to bear in mind that past performance is not an indicator for future results. Just because an investment has generated us 10% over the last 50 years, it doesn't mean that it will do the same over the next 50. For all we know, the US could be the next Japan. The Japanese stock market hasn't recovered to its highs that it made in 1990, 30 years ago. Still, it's something that no one knows. This is a move that could backfire on StashAway. If they wanted to play it safe, they could have just stayed in their investments in the US stock market and not many people would have complained because it's a cornerstone of most investments. They must have identified a significant overvaluation in the US stock market. My only questions to StashAway is what happens if the US continues on their bull run and the Asian markets continue to lag behind? How long can StashAway stick to their guns until they fold and say, okay, we're getting back in? I'm not saying that this will surely happen, but again, it's something that has happened over the last 10 years. Having said all this, I like this move from StashAway. Whether it will pan out in their favor or not, no one knows. I mean, this is the exact reason that I'm putting my money in StashAway instead of a regular index fund. Index funds don't do market analysis or identify shifts in trends. StashAway, on the other hand, is supposed to. I'm going to trust them on this and just hope for the best that the 3 new ETFs that they bring in start really pulling their weights. My individual stock portfolio is already very heavily weighted towards the US market. Having some change and having my investments diversified a bit is always a welcome change. If you want to take a look at the video where I share my entire portfolio, click on the link here. Next up, let's look at what StashAway has changed in the US equity section. In line with everything else that I've said before this, the US equity section has reduced by 25 to 40%. They've maintained their investments in some sectors, they've cut down on some, and they've completely removed on the others. A very bold move by StashAway. The reason I say this is because the biggest thing that they did, or the most notable thing that they did, is removing the technology sector completely, and more specifically, US technology. Of course, it doesn't mean that our portfolio has completely zero exposure now to the technology sector. As I mentioned before, they've brought in the Chinese internet sector to replace this. What this also means is that we're no longer invested in companies such as Apple, Microsoft, or Facebook. There's the argument that these companies are already so huge that they have little room for growth. Still, not many people are willing to bet against them in the next 5 to 10 years. I would say that this change is still acceptable since they've maintained weights in the healthcare and the small cap sectors. These guys have their own rights in terms of room for growth. I'm not gonna lie though, I still love my US technology stocks. In fact, I prefer US technology over any of the other 3 sectors that they maintained. I do admit, however, that these companies have had their runs, I mean, they've increased by so much over the last 10 years, and a rotation should be on the cards. So that's that for StashAway's portfolio re-optimization. Now, I want to go through some of the potentials and some of the threats of these changes. Starting off with the first potential winner of this change is the fact that many investment groups are starting to make the same shift of going from the US to gold and China. I like to read up on a lot of these articles, and I realize that a lot of big investment groups feel the same way as StashAway. Maybe I'm just missing out on something. In a way, I guess it's comforting for me to know that StashAway's views are not purely theirs. They have some good company that's riding along the same train. Next up, there's an argument that the Chinese stock market is very undervalued in comparison to the US counterparts. Now, this is something that I completely agree to. This is seen across many companies in China. It's probably because the US stock market now is one of the biggest in the world and the companies are very well known. Let's hope that the companies in the Chinese and the Asian market in general starts to go up. The final potential winner of this entire change is the fact that China is a growing economy, and not just China, the entire Asia. Over the past 10 years, China's GDP has risen by around 5 to 10% every year. In the same time period, the US GDP has only grown by around 0 to 4%. The potential that comes in China and the entire Asia is the fact that we have massive populations, and more specifically, a larger and increasing middle class population. Now, let's go into some of the threats that may derail StashAway's plans. First up is the potential delisting of the Chinese stocks in the US stock market. You see, Donald Trump is super mad at China, or maybe he's just intimidated. Regardless, what they're looking to do may potentially prevent Chinese companies from putting their stock into the US stock markets. Now, you may be thinking, so what? If you can't be on the US stock market, I can just be on the Malaysian stock market, right? Well, the thing is, the US stock market is a center point of all global investments. Because so many people invest through the US stock exchanges, more money is being put in and stock valuations are higher. If companies like Alibaba gets kicked out of the US stock exchanges, it might lead to a large outflow of cash that will run down its prices. Not all hope is lost though. Companies like Tencent, who is listed on a Hong Kong stock exchange, proves that you don't need to be on the US stock market to thrive. The second big thing that could potentially derail China's growth is the looming trade war and a shift in appetites. The ongoing trade war that has happened since last year will undoubtedly hurt both the US and Chinese economies. However, I'm of the opinion that China will be a bit worse off than the US. Since taxes are being raised on goods imported from China, people will start to buy less as they get less competitive, and it might really hurt China's exports. Another possible change that we could see stems from the pandemic. When the pandemic happened, it started in China. Because of this, the Chinese government decided that they were going to do a nationwide lockdown, which basically meant no working, no going out, and everyone would just stay home. Because of this, companies like Apple faced massive supply chain problems. You see, many of their manufacturing plants were based in China, and if China was closed, that would mean that no one is producing their products. Because of this, Apple started to realize that maybe having my entire supply chain just in China is probably not such a good idea. Apple has been considering some countries like Vietnam to open up some of their manufacturing plants so that they won't be too reliant on China. Some airports are already being made there, and if you look at your airports, you could see that some of them were made in Vietnam. If many mega corporations start to shift some of their manufacturing plants from China to countries like Vietnam, Indonesia, or Philippines, the Chinese market could really be impacted. To conclude, StashAway is making a very bold move by shifting away from the ever so popular US stock market to the less so Asian stock market. The removal of the US technology sector means we no longer have exposure through StashAway to mega corporations like Microsoft and Apple. However, there is a lot of potential in the Asian market. This could prove to be a genius move by StashAway, and us investors could potentially benefit from this. I'm going to continue depositing into StashAway every single week, and I have no plans to stop this at any time. As always, it's better to invest than to not invest at all. That's it for today's video. If you want to try out StashAway, you can use our link in the description down below, and you'll get 50% off your management fees for the first 6 months. Leave a comment down below. Do you think this is the right move by StashAway? My name is Emir, and thank you for watching the Millennial Finance. Peace out. Boop, boop, boop.